Thanks so much, and welcome everybody. Thanks for attending today. Before we start, I'd like to just quickly have our panelists introduce themselves. So Michael Shaulov, do you want to go first? And we'll go down the line to Mike Novogratz and then Stani.
Sure. Thanks for having me. My name is Michael Shaulov. I'm the CEO and co-founder of Fireblocks. We provide institutional platform for providing custody technology, transfer, and clearly we have a pretty broad set of tools for institutions to securely access DeFi. So excited to be here.
Thanks. Mike?
Mike Novogratz, I'm the CEO of Galaxy Digital. We're a cryptocurrency merchant bank. I think I'm the oldest guy in crypto.
Stani's not the youngest, but he's young. Stani?
Yeah, maybe not the youngest, but maybe most handsome. I don't know, Mike, Michael. Just kidding. Yeah, so I'm Stani Kulechov. I'm the CEO of Aave, and pretty much at Aave we have built interest rate market that is decentralized, running on Ethereum blockchain, based on smart contracts and governed by the community. And I've been building smart contract-based financial protocols, I think now for 5 years roughly, starting with the ETHLend, the first lending protocol on Ethereum. Before that, I used to build fintech applications and being kind of like a technologist always, and curious about finance, and happy to be here.
Fantastic. And as we said at the beginning, my name's Rebecca Rettig. I am general counsel of the Aave companies. And I'm happy to be here today to talk about next steps for institutional DeFi. The plan for today is sort of to think about institutional DeFi and what that means from a macro level, and try to get down to micro at the end to what real practical applications there are out there and how institutions can really think about getting into DeFi. So to start, Michael Shaulov, what's the current perception as you see it of DeFi among institutions today? And what types of institutions are most interested in getting into DeFi?
Yeah, that's a great question. So I think that, the institutional category is clearly big, right? There are very different, there is fair fragmentation. So I think that where we see most of the activity today, right, is among the funds, right? That the crypto funds that I think they feel very comfortable with the technology and with the alpha, right, that currently exists around the DeFi protocols, and we see a lot of activity over there. We're starting to see more and more of, I think, sort of the intermediaries, like the brokers, the OTCs, sort of tapping into the functionality over there and exploring that. And the exchanges. So there is a lot of sort of this CeFi to DeFi type of bridges that are being explored. And then we also starting to see some of the bigger fintechs, right? The neobanks starting to explore, and especially around, I would say, some of the functionality like what Aave provides, which is sort of USD-based interest accounts. We see that also quite a lot. And I think on the sort of like really heavy institutional side, which is sort of the banks that are, some of them are sort of entering this space or contemplating on how to enter this place. I think this is an area that fascinates them the most, but definitely this is sort of a very exploratory conversation for them right now at the moment.
Mike Novogratz, in terms of what you talk about in the level with other institutions and how you think about getting into DeFi, what do you think the biggest challenges are, and what's everybody talking about at the institutional level with respect to DeFi?
Yes, I think Michael, the other Michael, did a great job of kind of breaking down the buckets. I've had two, lunches / dinners with CEOs of 2 of the 5 biggest banks in the last 8 weeks. And the realization that Bitcoin was maybe a missed opportunity. It was an asset that they could have, bought and sold to their customers, custody, traded, but not a real threat to the banking system, has dawned on people. But they look at DeFi as a real threat. And one of them, we did a whole panel with the top 40 people at the bank they brought in a bunch of speakers, and the debate was, they were having a debate like, how are we going to approach this? Should we try to smash it, use our lobbying to smash it, or should we participate in it, right? And so I think those debates are happening. I think, my advice to all those guys was, you should at least have a sandbox where you take your 3 smart young guys and let them start experimenting, and you'll start learning how it works. When I started my crypto journey in 2012, 13, 14, we talked a lot about DeFi, bringing blockchains to finance, to cut out the middlemen, to make things more efficient, to make things instant, right? There's so many great attributes of atomic settlement, of bearer instruments, of composable products. And so, but it really didn't happen until, a year ago, where it surged. And so most institutions are behind the curve. And what's surprising is how fast they're trying to come up the curve, right? Because the journey used to be Bitcoin, then Ethereum, and then everything else. And now we've got some guys going right to DeFi, like in terms of their learning curve. And so I think the big hurdle, of course, for anyone who's regulated, is the KYC AML issue. And how am I going to get comfortable that I'm not dealing with a smart contract, and the other side of the smart contract is some terrorist finance or North Korea, and even though all the studies show that's a tiny, tiny, tiny piece, it's a giant piece of the mind share of the regulators and of the politicians.
Yes, I mean, it is, I do a lot of talking to regulators and have extensively over the past 6 months. Just focused on DeFi, and there's a lot of talk of KYC AML, and we'll definitely get to that point because it is so important, one, to address on this panel how we can address it. But before we get there, Stani, from a technological perspective, why should institutions feel, let's put the KYC aside for now, safe using the technology of DeFi? What's inherent in smart contracts and things like that make the technology really safe for institutional participants?
Yeah, I think from technical perspective, I definitely agree what Mike said. That also kind of like what's interesting is creating kind of like a sandboxes where institutions could come, the younger folks that want to actually innovate and try things out and come into this kind of like a sandbox. And I see when I started, my path is a bit different because I never got excited too much of Bitcoin in the first place. Compared to Ethereum, where I saw this programmability and what you can actually do by programming money and value as a store of value. That got me very much exciting from a experimental point of view. And I've seen always the DeFi or larger the Ethereum ecosystem in a way, or Web3, in a larger kind of like a place where you can innovate. And when it comes to decentralized finance, we have a ecosystem where we see lots of experimentations, different kinds of new protocols where we see communities trying to optimize yield, innovate a lot of things, and try new concepts out, which is very, very exciting and fascinating. But at the same time, we are building also protocols that are meant to kind of like be very resilient, very trustable in terms of like how they are built in economical perspective and the technical implementations as well regarding to that. And that's why we can see that the whole DeFi space is very wide. You have protocols that have been built and significant resources being used to build safely and securely, and also the whole due diligence process before going actually live. Just as an example, in the Aave protocol, the latest version 2, we had 5 different technical audits itself in the protocol, and so-called formal verification, where we mathematically review the code and ensure that the technical implementation corresponds what it should function, how it should function. That's only the technical side. Then when it comes to, let's say, liquidity pools where you can deposit and draw liquidity against other assets, what's interesting there is that you have this collateralization system, and then you have risk involved, and applying different risk frameworks. And what for me is very fascinating to see is that how decentralization actually strengthens these protocols, because in a normal situation where you have a trading facility in traditional finance, you might have a service provider who provides the liquidity, handles the liquidations. But if you look at DeFi at the moment, there might be hundreds of liquidators running at the same time, competing of those liquidation opportunities to keep the protocols solvent against a reward, against an incentive. And what crypto economics have pretty much done very well when we look into open source is actually creating this like incentive models. And I think in overall, like what makes DeFi safe, it really depends on the protocols that are actually being talked about, what kind of measures, procedures they have. And over time, I think as these protocols get more and more time on mainnet, less and less issues will be found over a longer period of time. So I guess like that's our take. Like we are trying to build for institutions, but also what institutions need to understand is that and see is that DeFi is also used as a sandbox at the same time. And there's like different differentiators here.
Yeah. And a lot of when I talk to regulators about DeFi, a few of the things I talk about is the automaticity of smart contracts, and how, you know, when you're interacting in the traditional financial system, you have to rely on the intermediaries. That's why regulations are written with the word person in them, right? They're directed toward natural people, or if an intermediary is an institution. But when you have smart contracts, which are self-executing computer programs that are stored on the blockchain, the transactions are automatic, which means they can't be manipulated by outsiders. And there gives a lot of certainty in the outcome of transactions. So between that and that these protocols are non-custodial, so you always have control over your own assets, I think is a very different way to think about financial transactions, but gives you so much autonomy over how your transaction works that it should give you some security in terms of how the system works. So, well, I'm the only lawyer on the panel, I'll pose this as a general question, and Mike Novogratz, let's start with you, but in terms of, and let's put KYC aside because we're definitely going to get there, but in terms of thinking about regulation and DeFi, other than the KYC question, what are the challenges that institutions see in terms of getting into DeFi and what that may mean with respect to respect to the regulatory landscape? Well,
I think there's the uncertainty around it, right? We haven't had any real clarity from the regulators. I mean, you can start with the base case, right? When Brian Brooks wrote his paper on driverless banks, his basic thesis was once you solve that KYC, there's no one to regulate. It's just code, right? And, you know, there was a lot of DeFi projects in that first surge, I don't know, last fall, that weren't ready for prime time, right? There was bugs in the code and people lost lots of money. Let me tell you, the regulators' primary mission, if you're the SEC, if you're Gary Gensler, is to protect the little guy.
I know.
So the community needs to self-regulate a little more, like pull back the greed and make sure the programs actually work. Because each one of those, you know, and you can say like the libertarian side of crypto says, screw it, buyer beware. They knew what they were getting into, but they were getting paid all that extra yield for those risks. That message doesn't resonate with regulators. And what's clear to me is regulators are going to care more and more about that, forgetting what institutions do, just about how retail punters, retail investors get treated. And so in some ways, the energy of the community needs to shift a little bit to being a little bit more concerned about how the customer is treated. Now, that's intuitive, right? If you have a shitty product, you go out of business pretty quick. But like that, there's that tension there between is this stuff real or just a weird casino versus, and some of that is how battle tested it is, how long it's been played. And so I think we're just so early. Again, the more aggressive hedge funds, you know, certainly the crypto funds, and then, you know, some of the crypto big venture players who have huge war chest of tokens. And now hedge funds are moving in. And everyone else feels more comfortable investing as a VC, right? like even all the VCs, most of the VCs invest in the protocols, but they don't use them. You know, and so I think that shift has to happen, and I think it will happen in the next, 3 to 24 months.
Yeah. So, Michael Shaulov, Fireblocks is a regulated entity, and so you're coming from a different perspective. But in terms of seeing the CeFi, DeFi, and moving institutions into DeFi, how do you guys think about the regulatory landscape and the challenges that may be presented? And I think it was really helpful that Mike gave sort of, action items of what needs to happen. As an aside, I can tell you some of it is already happening behind the scenes in terms of self-regulatory bodies and things like that. But I'm interested to hear what you think.
Yeah, so I mean, actually, just to make it clear, Fireblocks, most of Fireblocks is actually a technology provider, right? So we have Fireblocks Inc. and Ltd. that it's actually a technology provider. We're providing a software, and basically we serve the regulated institutions, but it's a self-custody or direct custody technology. And we also have the LLC arm, which is sort of doing specific capabilities, which is like, operating under MTL licenses. I think, from our standpoint, I think that everything that Mike said is something that when we engage, most of our engagement, right? So 30% of our clients right now, or something around that, are active on DeFi, right? So every day I'm actually seeing more and more clients that are activating our DeFi capabilities. But at the end of the day, it is because it's actually being consumed through our self-custody, direct custody technology. They're mostly taking, they're taking their view in terms of what does it mean to their license, what does it mean to their activity, and whether they feel, most of the people that engage over there, I guess they feel comfortable already in terms of engaging, right? I think that, by the way, to Mike's point earlier, I think that the biggest challenge there, just conceptually, although from a regulatory standpoint, it is the KYC and all the stuff that we're going to talk in a minute, but it's actually the technology risk, right? Because what really difficult to explain to people is that you now have this sort of magical thing that, as an example, you can take US dollars, convert it to something that's called stablecoin, and then it takes you basically like 30 minutes to explain people the concept of stablecoin, and then you tell them, well, then we push it into the blockchain and it gives us like 6% yield per year, and then people ask you, how come I can't get it from my regular bank? How come Bank of America or Wells Fargo cannot get me the 6%? And where is the risk? And then you tell them, well, look, technically speaking, there is no risk, because if someone is, there is sort of it's over collateralized, and basically if the collateral drops, you get automatically liquidated. It's like the most efficient market ever, and you have the biggest market makers that operate as liquidators. And then people ask you, okay, so where's the catch, right? And the catch is essentially that it's new, right? And things happen. By the way, we have seen, even with some of the most established protocols, that there were issues, with oracles. There were basically liquidations that were sort of to a certain degree unplanned. And I just think that it's sort of, for me, actually, as a technologist, right, this is just sort of iterations that the technology matures to the point where people feel comfortable, right? No one asks, what are the technology risks with DTCC? Although, as we've seen with the GameStop, saga, there is a fair amount of a technology risk with the way that, or just counterparty risk with the way that they operate. Robinhood, that they had to basically pull $1 billion credit line to basically, operate under those conditions. So I think it's just sort of a matter of, becoming more battle tested. And I do, I do understand the concept that people sort of ask, who do we need to regulate, and what happens if something goes on. But in some ways, this is where technology is heading. Like, how are you going to regulate self-driving cars? right? If a self-driving car hits someone, and who are you going to sue, right? The programmer or the AI. In some ways, I think we are going to face this kind of challenges actually across the board, across all the technology sectors, that things become much more autonomous. And there is actually a big question: what does it mean from a regulatory standpoint?
I agree with that. I think who do we hold liable and how if something goes wrong is exactly what the regulators always ask and are super focused on. And to your point about software, you can't regulate writing software because at least in the United States, it's protected by the First Amendment in some way, shape, or form. And while not only they don't always love this answer, but the answer is there are other schemes that will protect users if something goes wrong. There's tort law, there's contract law, whatever it may be. But it doesn't mean that regulators can reach out and start regulating software development. But now to finally get, without too much anticipation, to Mike Novogratz's point about the focus on KYC AML, and he's exactly right. There, it's all everybody's talking about constantly. And I think the FATF guidance that came out in March was really focused on that point of it and collecting information and knowing who you're dealing with. Obviously, that is the most important question for institutions, because even if they want to get into permissionless DeFi, they have certain rules and regulations which they abide by. So, Stani, tell us if there's a solution out there for institutions to start thinking about getting into DeFi, but with the protections of KYC and AML around them.
Yeah, definitely. I'm a very big believer in kind of like permissionless finance and access, and because it's a permissionless, not just permissionless access, but permissionless way to build the financial protocols and new primitives. But also, I think kind of like to have a way of onboard institutions and comply with different kinds of risk appetites regarding, especially to compliance. One of the ways that we are actually working in the current state with all of the panelist entities here is a market where the liquidity and the access into the market is permissioned and segregated from actually the permissionless DeFi. And this is actually a very fascinating way to use smart contract infrastructure between multiple market participants and provide accessibility to institutions without actually with actually knowing their counterparties and mitigating the risk of, for example, in compliance. And this is kind of like a fascinating because essentially what it means is that it provides institutions a way to actually experience decentralized finance and have all that transparency that DeFi brings. And that's one of the powerful things about DeFi, and also manage this market in a community owned basis. And in a way, what we believe is that by creating this kind of like ability of whitelisting and blacklisting addresses regarding this institutional market, it's easier to scale in institutions because it lowers the risk in general. And regarding the kind of like a whitelisting functionality, that's pretty much what custodians are doing, and pretty much effort led by Fireblocks as well. So essentially, what I think is that there will be always permissionless finance, and there's this other risk involved to that regarding to compliance. But then we will have different kinds of permissioned markets, kind of like we will see like a private pools, I would say. And regarding the compliance, geographical locations of those counterparties, and that's kind of like how we see that DeFi will be more layered and tailored to specific needs and requirements.
Yeah. So I have two follow-up questions. One to Michael Shaulov, which is, how do you see Fireblocks participating in this world? What is the meaning behind it? And why does it give assurance to, or why should it give assurance to institutions who want to get into DeFi? And then Mike Novogratz, I want the coup de grace to be with you, is, does this give assurance to institutions on the KYC AML front?
Yeah, so essentially what we, what Fireblocks was doing to date, we basically were onboarding a fairly large set of institutional parties that we're using our software to basically access DeFi. In parallel to that, as I mentioned, we basically have the MTL arm that, regardless, by the way, the license, it has basically compliance capabilities, and it can basically KYC. So we are able to basically operate within the network where we already know the participants. And it's a fairly large network of people that already either accessing DeFi or they want to access DeFi, but they want to get the assurance, right? And we are able to basically validate and vet them into the network and essentially create this sort of gated community that, at least like on phase one, is operated on the principles of the Fireblocks network, right? Where we are able to vet the participants through methods that were agreed with their GCs, right? So we actually went to the different GCs of, the leading and probably the most regulated institutions in our network to collect their feedback in terms of what information they want us to collect, how they want us to vet the vendors, and just generally speaking, there are pretty clear policies and procedures around that, right? So we are able to perform that, and eventually, because we do have visibility and part of the provisioning through MPC of those wallets, we can basically then whitelist them essentially into those pools and allow them to interact with one another while guaranteed that they are sort of isolated from the general pools. That's sort of like, I would say the phase one approach of that. And then clearly that approach after, I would say, this sort of pilot phasing can be extended to, I think, to two main directions. One, to even reinforce their, more ideas in terms of how we reinforce the compliance and the security of the access into those pools. And the second approach is actually how do we sort of open it up to other providers more than Fireblocks, right? Because Fireblocks is not sort of the only technology or custody provider out there. So clearly this has to go out, and we, after that pilot, we will basically, this will be extended to the rest of the institutional community through various forms.
Great. Mike Novogratz, what do you think?
Yeah, listen, when I step back, there's kind of three ways to think about this, right? The original was, well, and this works for all of the retail players. Hey, I'm executing against a smart contract. It's just a smart contract. What are you talking about? There's risk of KYC and AML. It's a contract. And so a lot of people kind of participated with that mindset. And quite frankly, you don't see the, Department of Justice kicking in, grandma's door for playing on with retail at retail level. We took a more conservative approach, said, okay. And, once you say that's not good enough, there's kind of two options. There's the walled garden option, which, both Michael and Stani were talking about. And then there's the kind of chain analysis, chain surveillance compliance option. Can you do enough work on where the transaction is coming from that you feel with a high degree of probability? I think both of those are going to work to give a prophylactic to the user, right? So we'll be more comfortable in each of those environments. And I'm not positive where the regulators will come down. And so I think you're going to see an increase in user, because somebody like us, we're going to be more comfortable participating in DeFi more aggressively, given we can say, hey, we did this and we did this. The $64,000 question for Stani, for Michael, for anyone who's running these protocols, are the regulators going to say, hey, we love you for being 82 or 46% regulatory compliant with your good customers, with your white labels, but we really don't like the blacklist customers, and pick your poison, right? Like, I don't know. And this is just it's more of a question than instinct. I do know that the long arm of the law is really long, and you can, ask poor Arthur Hayes, wherever he is. Like, if the regulators want to get you because they think you're doing something wrong, they're going to get you. And so that'll be the bigger question. Will businesses like Aave have to say, we're not going to be open and permissionless like we were. Like we're going to have some form of KYC, no matter how it comes in, to let the regulators continue to allow them to exist. And it's an existential question. I don't know the answer. I just know it's going to get asked.
It's already being asked. I can give some context around it because I have a lot of these discussions, but I agree. The one good thing I will say is regulators both in the US and across the globe are actually spending time to try to learn about DeFi before they do anything. And so collaborating with regulators, spending time educating is something, one, I think we think as a company is really important. I think Stani can talk to that too. And two, a lot of the players in the space are really engaging with the regulators and trying to do education about the distinction between something like Aave, the companies, versus the protocol, and that there's actually a disconnect. I think the ways KYC AML can be done is twofold, kind of complicated, because you can always get onto a protocol directly from Ethereum. You couldn't do a KYC AML on somebody. That's obviously a highly technological way to get onto a protocol. And for something like Aave Pro, where this permissioned environment that Stani was talking about, you won't be able to get on directly just because of the way the technology is written and works. So you will always have a very closed system. So those kinds of things. But I will also say, just because I see a lot of things come through, and Stani probably does too, but there are also native compliance solutions that are being built right now from within the industry to take KYC AML and make it automated and technological. And so I think there are lots of opportunities for us to see how this can all work from a technological perspective, and one that allows the benefits of DeFi to continue being the benefits without really bringing it into the traditional financial world.
Rebecca, one thing that I'm going to pitch.
Okay.
I don't think the community has articulated the benefits clearly enough on why DeFi is so awesome, right?
Yeah.
Like the big macro is, okay, we're going to cut out the rent taker, and the emotional was, look at these yields I'm getting. It felt like a big casino at one point, so especially early on. But like really articulating why this could change, why this could become a platform of huge innovation, right? We didn't think the iPhone would create as much as it did, but all of a sudden you put a camera on it, you put GPS on it, and then you had Uber, and you changed the whole world. And so it's kind of articulating in a broader sense, guys, it's not going to be perfect day one. The KYC is not going to be perfect, but we're committed to making it that way. But like, don't throw the baby out with the bathwater, because man, the baby is a pretty precious, piece of cargo.
Yeah, and so two things on that. One, I presented to FATA Fund DeFi in April, and like the whole beginning of my presentation was like, why is this a good thing? Like, what's good about DeFi? But you're right, we do need to make sure we're doing an education campaign so that the benefits of DeFi and why it is superior in certain ways to the traditional financial system, why the banks have to be a little nervous about it, is out there. So I agree with you that there needs to be a push on that. And there is, we're all sort of working on that behind the scenes too. So Stani, where do you see DeFi going from here with respect to institutions? In addition to this permissioned world, how can DeFi and institutions work together? What do you hope to see develop? Things like that.
Yeah, I mean, definitely we are very, very early. And I think kind of like what Mike said about the power of DeFi, we now see like kind of like the opportunities from like business perspective, that there's a lot of yields and what you can actually attract compared to what's happening in low interest environment in the traditional finance. So definitely there's like interest from that perspective, but the kind of like a longer vision here is that as a DeFi, with the components of being able to interact directly with the protocols without giving custody, give sort of programmability to create new protocols on top of already existing infrastructure, and also in a very transparent manner. So this transparency that decentralized finance brings, and also kind of like the governance of these protocols, is a very, very big impactful value proposition, because end of the day, when we look back in time periods of, for example, 2008 and financial meltdown, it was very difficult to understand how different banks and financial institutions were exposed and towards each other. And in decentralized finance, what makes it very, very beautiful is that when you look at DeFi, you see all the exposure you have in terms of, let's say, debt in Aave, what kind of collaterals there is, what's the liquidity available, let's say in Balancer or Uniswap and other swapping protocols, and in overall the whole system. For example, stablecoin, you will see like how much stablecoin are in Aave or somewhere else. And this kind of like a transparency not only brings the opportunity to anyone audit decentralized finance every single second, including regulators, including market participants, which makes the information symmetry very fair to every market participant. But also, I would say like the ability to build, just being a developer any part of the world and being able to build competitive algorithms creates this kind of like a constant flow of innovation, which means that everyone is competing of innovating better and better algorithms, which makes finance more and more efficient. So when we are always saying that DeFi is moving very fast, there's so many things out there, and definitely agree, because everyone is just innovating on top of network that is accessible to everyone. And in terms of institutions and permission functionalities, I think what we will see more is actually institutions becoming more and more also kind of like a front end and service providers for a larger audience. Because I think with the current scalability of the networks that are used, for example, Ethereum, you can't onboard 100 millions of users interacting on a daily basis, calling smart contract functions. You might have to be more smart on that. For example, we might see entities, for example, like Fireblocks, that they are onboarding a lot of users, but bundling transactions, and we will see this kind of like activity on the institutional side. And I think what's missing also is like more tooling in terms of like risk tooling, understanding what are the risks involved. Let's say when someone deposits from the institutional side into the Aave Pro market, and understanding the risk involved, technical risks and economical risks. And this kind of like information is something and tooling that is definitely needed in the space when we go like more wider in the institutional front.
Yeah, and then final question to both of you, and then I have one final point to make, and then we'll take some audience questions. But to both Michaels, sort of what do you hope happens, let's say in the next 6 to 18 months for institutions in DeFi?
You go first.
Yeah.
Yeah,
so I think that sort of to relate to everything was said here, but some of the projects that I see that are going to be really interesting is sort of actually bringing more traditional assets, right? So I think there is a big correlation between, I think, the success, like the real utilization of, for example, DeFi to, for example, stable coins, right? It's not clear to me that without stable coins, DeFi as it is today would have been as powerful. And I think the fact that we're bringing assets such as like, NFTs, which is sort of on the edge, but I do think that we are starting to see more and more projects for sort of the resurrection of tokenized securities and things like that. The ability of basically start representing real world assets on the blockchain, including, by the way, like stable coins, that really, I think, brings the traditional or the institutional market closer to real utilization of smart contracts. Just like as an example, we've done a demo in an RFP to one of the biggest banks in Europe, where we actually show them, a smart contract, a tokenized security smart contract that was executing using Uniswap against a CBDC token that was issued by their central banks on a true ERC20. And then you sort of like, see the power of that, of how it is being done, not on something that they view as some sort of like, interesting, side experiments, but on something that is the mass or the most massive financial instruments that are just like utilized across the board. So I think that this is something, I don't know if we're going to see it in the next 9 to 12 months, but I think this is sort of like, the 24 months, 36 months utilization. And, the banks that we are working with, they are definitely like interested, especially in the context of things like Aave Pro, to apply it on those assets, because not only that you have the KYC architecture that protects you from, say, the bad actors, it also can be used for other things like, making sure that you have access to that only accredited investors and other compliance mechanisms that are important for the more interesting asset classes that can be pushed there.
Okay.
Well, first let me say, we had this crash, 5 weeks ago? You can call it a crash, right? Bitcoin, Ethereum, all the DeFi coins got shellacked. People got stopped out. Interest rates shifted pretty dramatically, and the system works. And so I think that's a great, great thing and a testament to all the builders out there. So hats off if you're a builder. We didn't have the plunge protection team. We didn't have a whole bunch of lawsuits. We didn't have, like, people got stopped out that were supposed to get stopped out. Balances shrunk. People got liquidated. Painful for a lot of consumers, but the system worked. And so I think, given that Bitcoin's 13 years old and Ethereum's a heck of a lot younger, and all these projects are really babies, it's pretty awesome what's been created already. My big hope / worry is that we don't have, regulatory overreach, regulatory capture. That I really think, more so than any time in my career as a Bitcoiner or as a crypto guy, the need to engage with DC, certainly in the US, but broadly, the other thing that's so cool about this asset is it's global, right? This is the first global financial system ever, really. And so I focus a lot on the US because the US is still so important in the global architecture of things, but it's probably equally important to be out there in Europe and in the rest of the world. And so, listen, I'm bullish, I'm optimistic. That's my nagging worry, and it's not coming out of nowhere. It's coming out of all the damn phone calls I keep getting.
We're on it. We're on it. We can have a separate call and I can tell you everything that's happening behind the scenes. Look, and the one point I wanted to make before we take questions is, like, the most important thing right now is patience. As everybody sort of made clear here, like, this is a nascent industry. Things are being built up around it. And it has taken hold very, very quickly. And I think gotten a lot of people excited. But as far as any risks or unknowns or things like that, the industry is on it. They're focused. And there's a lot being built up around it. But a lot of times I get questions like, oh, well, I thought it was supposed to be banking the unbanked. Why aren't we doing that yet? We will. First of all, there are good examples of how it's happened, but DeFi is like 2 years old. Give it a little time to grow. So I think some of that, and I think regulators understand too that any regulation that comes in needs to make sure that it allows, or I'm hopeful, allows the industry to grow as well. Okay, so I'm going to take a few audience questions before I do that, or before I keep going. So I'll leave this open to anyone. It's really interesting. I actually haven't gotten this question yet in any panel I've been on, but someone asked, do you see a role for rating agencies like S&P to be involved in DeFi so that market participants can discern risk levels or have a better understanding around these different assets that are out there?
Let me answer that only because we've got a customer-facing business with a big research department that's growing. I would hope businesses like ours, and guys like Alex, who runs our research department, have insight and provide good research on, hey, we love this protocol because of X. We're nervous about this protocol because they, threw it up in 72 hours and it, really hasn't been battle tested. I'm not sure you're going to have an outside rating agency anytime in the next 5 years. And so I think that role is going to fall on businesses like Galaxy and our competitors.
Okay, I like that. That's an interesting answer. Stani, so there have been some questions about, are there geographical differences in institutional DeFi adoption? So the person who's asking is based in Switzerland and is thinking about how conservative or progressive Swiss institutions have been compared to the US.
That's a very, very interesting question, because when we started to build the Aave Pro market, and a lot of interest went into that, and like we received some inbound, and kind of like we definitely see differences in terms of like geography, what kind of expectations there are. I would say in UK it's more about discussions with fintechs. In US it's more about bigger market participants who are either already somehow involved in crypto but are highly regulated. And in Switzerland we also have like kind of like our own type of progression, where we see private banks becoming more interested in thinking on how to get involved into the market. And one interesting observation is that for example, the Swiss space is more local, in the sense that there isn't appetite, for example, to have yet US counterparties. But that's the beauty of the smart contracts of the Aave Pro infrastructure, because we can always deploy new set of smart contracts specifically to a certain type of counterparties. And essentially what you can do over kind of like a long-term horizon is that you can later then connect all of this infrastructure together when there's that kind of appetite to do. And hopefully that day comes at some point.
Great. Michael Shaulov. For people with an institutional finance background, where are the opportunities in DeFi to make a career transition? And Stani, maybe you want to jump in on this one, but to make a career transition. And there are forums for whatever, for whatever people are interested in. The Blockchain Association definitely has a jobs board, as do some others. But how do you think about people, Michael, moving from a more institutional background and coming into DeFi?
That's a good question. I mean, it really depends on the profile of the person, right? So depending if they're like on the technology side, compliance, sales, and so on. I mean, we have, I would say where we had a lot of, hiring was mostly on the sales side, right? Basically, our sales team, we have, a decent amount of people that came from traditional financial institutions, and also compliance and somewhat operations. Although, to be quite honest, at least like for us on the technology side, we are very much a cybersecurity company. So most of the talent that we pull into the technology is really like from hardcore tech cybersecurity companies. But clearly there is also quite a strong appetite for those for like financial technology people in protocols or in areas that are up the stack from us.
Excellent.
I can maybe say that at Aave in the team, like there's two types of hiring. There's hiring that is happening like within the community, in the community getting organized in terms of the decentralized organization and involved with the grants DAO. That's kind of like an open process where there isn't necessarily roles like per se, but if there's some task or you're interested in getting involved into the kind of like the DAO work, it might be development work, it might be some other type of work, for example, risk related work. That's somewhere where we can start. And then of course, like at the Genesis team itself, what we are doing, we pretty much deploy protocols and give the ownership to the community as soon as these protocols are always ripe. In terms of hiring, decentralized finance is a very, very fascinating space, and crypto in general. Whatever kind of like functioning there is, and whether it's trading or the tech part. And I would say that everyone who I got from traditional finance or have been able to recruit from Web2 world into the Web3 ecosystem, everyone has been excited, and I haven't seen anyone leading back. So it's very fascinating. And I think the best time to start your like Web3 career is definitely now. There is a lot of excitement going on and a lot of opportunities. And it's just so interesting. And I mean, for me, when I started to read about Ethereum in the first place and blockchain and how Bitcoin works, like that gave a lot of like, I mean, I didn't sleep for days. I just like started to read more and more and understand like how the system works. And that's something that everyone who comes into the space, comes into DeFi, starts to read about protocols and how they work and the principles of DeFi. That brings that's the experience. And I think now is a good time to start your Web3 career if you are in traditional finance.
Yeah, Mike Novogratz, one of the questions is, what will be the triggers to create hardcore FOMO for institutions?
Well, listen, we had it this year, and it's always leadership, right? If you want to think about each bucket of institutional adoption, like Paul Tudor Jones, who's one of my favorites, you know, he wrote that letter about why he was buying Bitcoin as a hard asset. That allowed every hedge fund manager to participate, because they might not be right on their bet, but they're not going to get fired for looking like a fool. And then Stan Druckenmiller came in and Ray Dalio wrote about it. And all of a sudden you had the lords of the hedge fund industry saying it's okay. You know, the same thing happened in the insurance business with, you know, Mass Mutual and New York Life. Even though they make small investments, once guys make a small investment, they start making a bigger investment. And so you've got to kind of look for marquee investors that credentialize your space. That's just the way the FOMO works in the institutional world.
Of course.
We haven't had any giant pensions yet, even in Bitcoin, right? The state pension funds yet.
Yeah.
But they're coming. And I would almost bet my shoes, my shirt, and my pants, which would actually not be a great sight if I lost, that it happens within 6 months. We're talking to tons of them. You can tell they're getting closer. The moment you have 2 of those in,
here it's over.
And so one of the reasons I'm so bullish and we keep hiring people is I see that progression in every asset class. DeFi's just gotten started. And so, you know, maybe it's not as close as the next big Bitcoin investor, but like I said earlier, I'm shocked at how many people are jumping right to it in the more aggressive sides. And so, and I know the banks are fascinated, right? Fascinated with this. And so, you know, I mean, we look at it, you know, within our lending portfolio, we can lend this way, we can lend that way, we lend through DeFi, right? And all of a sudden it becomes just part of your overall lending portfolio. Yeah. And I think that's what's going to happen to the banks first.
Yeah. And I think a good narrative to your point about educating and stuff like that is to make sure that all of these big marquee names understand that Bitcoin is it's the beginning of DeFi, right? It's the permissionless way to transact with payments, and DeFi is just building on that to allow a broader set of financial transactions with the same type of technology.
The other thing, story I don't think gets enough is that when you open it up, the innovation that can happen, like we don't know what the TAM is. We just don't, because we don't know what the next Stani is going to build. Hopefully.
What Stani is going to build next, I think you mean.
Oh.
Sorry, go ahead. I didn't mean to interrupt you, but it was too easy. Go ahead.
That was my whole point. So.
Yeah. And look, people, the rate of innovation is so fast. Stani and I were on a call today, and he basically said that you put out technology and it's old the day you put it out, you know, so. Yeah.
The amount of talent, you know, we were talking about how to get a job. In the amount of talent coming into the space, we were kidding. We have, I think, 14 summer analysts, not even, you know, not our normal analyst class, our summer analysts. And I'm like, damn, I couldn't get a job as a summer analyst. I mean, they are smart cookies, and they're dedicated, and they're, you know, they're in there. And so I see so much young talent coming into the space, and older talent, that I said this before. The total market cap of all of crypto is less than $2 trillion. I don't know, it's $1.5 trillion. But then if you add Coinbase and the public companies and the privates, and call it $2 trillion, that's less than Apple. And if you put all of the the Michaels and the Stanis and the Vitaliks and the Joe Lubins on one side of a football field and put the Apple workforce on the other, you'd have applesauce at the end of the match. Like there's just so much human capital. And I'm not knocking Apple, it's one of the great companies. I got my phone. We haven't come close to scratching the surface. We're 30 basis points of global net worth. And it just doesn't make sense to me that there's this much human capital in only that much, GDP.
Yeah. So for the last question, it builds on something you said, Mike, in terms of just making sure that people understand the benefits of DeFi. But Stani, how do we, and you're very good at this, so this is why I'm asking this question, but like, how do we explain DeFi to lay people? Because, it can be hard to understand from a technological perspective. And, how do we make sure that it's clear that DeFi use cases can change the life of a regular person and things like that?
Yeah, definitely. I mean, it's very important. Kind of like there's two routes. I think there's a route where decentralized finance becomes the software of finance. And it's used in the backends. Some people who are more conscious about keeping self-custody, they access decentralized finance, right? Like directly. And then other people might rely on service providers and the Coinbases of the world and Fireblocks, for example, or use some sort of like a fintech in that sense. And they kind of don't know that DeFi is operating in the background. So there's this kind of like two paths. Like either we go into a direction where we explain to everyone, like we focus on education, that this is finance, and being able to pretty much choose whatever finance you want to do, use, you should be able to do that. And decentralized finance gives you this ability, and also you can build better products. If you don't like the way, for example, some sort of financial products are built, you can build better. And kind of like it all goes back to the principle of it's how do you store your private keys and so forth, the very same that we have in Bitcoin and cryptocurrencies in general. Or there is the route where we are actually just in some extent focusing, okay, this is DeFi, and let's explain to the major participants, and then they will onboard users however they want to onboard. I personally believe that both of the models will go forward, but I want to believe that kind of like self-custody will be the way to go. But also I would like to see it becoming more easier than writing 12 to 24 words in a piece of paper and forgetting it somewhere. So that's kind of like the challenge at the moment. But I would say, just like in general, and decentralized finance is just open network where you can access any kind of financial protocol out there. Everything is transparent. You see the whole space, and it works without actually it's nothing stopping it. If you go, you can't access, let's say, a financial system in traditional finance over the weekends, for example. You have slow settlement systems, but DeFi works all the time, like autonomously. That's the beauty of the system.
Yeah. So we are unfortunately out of time, but I want to thank everybody for their time today on this panel. I thought it was a really great conversation and less of a, question and answer. So I'm glad we all could really get into the topic and talk about it meaningfully. I know we're all passionate about the space, and hopefully that was conveyed to all the participants today. And thank you, Stani, Michael, and Michael, for your time.
Thanks, Rebecca.
Thanks.
Bye, guys.
Thank you, everyone.
Bye.